We're back. Disney shares have sputtered lately after a solid start to the year. Investors will be watching the company's earnings closely tomorrow for signs of where the consumer currently stands. Jim Stewart is columnist with the New York Times. He joins us now. He's also a CNBC contributor. This is our quarterly visit. It's nice to have you as always.
Good to be back.
I feel like we have the same type of conversation. Parks and streaming, is that the whole thing this time?
Well, I've lately gotten way more interested in the sports segment, which they now break out separately, because ESPN is finally going direct to consumer this fall. At least it's scheduled to go. We'll have to hear what they say about that. That is a seismic change for this company. When you look back over the years at how profitable ESPN has been, how profitable that franchise has been, even last quarter, there was $4.5 billion in revenue.
That's a lot.
That's a lot.
Not has been, still is.
It's still big. And this is, once you can get it streaming for what looks like it'll be about $30, how many people are going to stick with the cable? So, this is also a seismic event for the whole cable industry, because so many people, I think, only have the cable now to get ESPN.
So you're thinking about, can direct-to-consumer, I don't know if be as profitable as cable,
Nothing's ever going to be that profitable.
In any way replicate the profitability of, maybe not be as vibrant.
Exactly. And I think that's why Disney has waited so long to actually take ESPN to direct-to-consumer, where they launched streaming elsewhere much sooner, because they have this golden cash cow that they've been milking now for many years. But again, they had $4.5 billion in revenue, but the profit was down 17%. The cable model is disintegrating. It's not going to go away overnight, but I think we may see a very rapid decline in the cable revenue as people move. Now, $30, it's a decent number, but that's never going to get them to those kinds of revenues. If you wipe out the cable revenue, you need a lot of subscribers to get up to that level. So presumably they're going to, they'll get people in there, then they'll raise it, they'll find out how price sensitive are people with this. So there's some big question marks, I think, right now over Disney's future.
What about the parks? Julia Boorstin was talking earlier on a prior show, talking about increased competition. Our parent company has some new offerings relative to Universal. How do you think about that? It's a good read on the consumer, obviously, too.
Yeah, well, the parks are primarily sensitive to consumer sentiment, and Disney stock really took a hit when people were worried about recession earlier in the year because of the impact on the parks. And I think a lot of that has dissipated. I think competition in the theme park area is kind of weird. There's a new park in Florida, but then everybody just goes to both of them, or they stay longer. There's some synergy there. So I'm not concerned about it. They're going to open that Abu Dhabi, I think, thing they mentioned. They've got new cruise ships coming online. They're investing quite a bit of money in it. I think it looks pretty good. I think another really bright spot for them is Iger has kept the costs under control. He's done a great job at that. He's been very disciplined. Everybody is complaining about it.
I wanted to go there because you set that up perfectly. Because it leads in some part to the succession conversation.
Right.
So he's already spending less. The creative community is probably up in arms.
Yes.
The issue in part with Mr. Chapek, who was the prior CEO, was a disconnect, I think is fair to say, between the C-suite and the creative side of the business and in Hollywood. Mr. Iger has already laid the groundwork for the cost cuts. So now the new CEO doesn't have to be the one to announce big cost cuts or a change in the model. Does that help whoever the new person is going to be? And do you have any inkling on when exactly we'll know in early 26?
I don't know when, and I don't know who. Of course, everybody would love to know. But yeah, I think Iger has, prepared the glide path for the new CEO. It's hard to see how much more they can cut. They really have, they've got to keep producing new material, and everything is not going to be a hit, as we've seen this year. So they're going to have to spend, and the fastest way for a new CEO to become popular in Hollywood is to open the spigot a little bit.
Well, of course.
And he or she will be under pressure to do that. Every agent in Hollywood would be, calling, for let's do another deal, let's do this. It's like up the spending here. So there will be that kind of pressure, and there may be some leeway for a little more spending. And again, one of my concerns about Disney is, can it stay this lean forever? It's got some, significant competitors with deep pockets who are spending. Apple is spending, Netflix is still spending. The legacy producers are not spending. and that's taken some of the pressure off. But you look at the Disney lineup; it's very conservative, it's very sequel-driven. Can they keep that up indefinitely? I think that's another big question.
All right, a lot of intrigue, and we will talk more about that. Jim,
Great.
thanks. That's Jim Stewart, New
Nice
York
to be
Times.
here.
We'll see what these numbers are.